Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
If you're in the startup world, you've heard the stories. That promise of equity, that little piece of paper that could be a lottery ticket. But here's the thing, understanding it is what separates a life-changing payday from an absolute financial nightmare. So today we're going to break down exactly what you need to know about startup stock.
Right, so how can that offer letter, that one piece of paper, be the key to making you a millionaire? Or, on the flip side, leave you with a completely unexpected massive tax bill? It all comes down to how you manage that stake in the company's future.
You have to put yourself in the shoes of an early-stage startup. They're scrappy, they're hungry, but they're usually not flush with cash. They can't go head-to-head with Google or Apple on salary. So what's their secret weapon? Well, they offer something that's potentially way more valuable. A piece of the pie, a piece of the company itself.
And that's where this thing called equity compensation comes in. It's pretty simple, really. By giving you an ownership stake, the company makes its success your success. When the company's value goes up, your slice of the pie gets bigger too. It's designed to be this incredible win-win for everybody involved.
But here's the thing you have to get right away. Getting equity isn't just one simple thing. Nope, there are actually two main paths that startups use to grant it. And believe me, the differences between them are absolutely critical. We're talking about stock options versus restricted stock. Okay, so let's boil this down. Stock options give you the right to buy shares down the road at a price that's locked in today. Think of it like you're reserving your spot. Restricted stock, on the other hand, means you get the actual shares, actual ownership right now. The feeling's totally different. One's a future opportunity, the other makes you an owner from day one.
All right, let's dig into stock options first. And honestly, the best way to think about it is like a coupon. The company gives you this special coupon that lets you buy their stock at a fixed price. We call that the exercise price, no matter how high the real value of that stock might climb.
It's a three-step journey, really. First, the company grants you the options. That's the offer. Then, over a period of time, usually a few years, those options vest. That just means you've earned the right to actually use them. And finally, to make it all real, you have to exercise your options. That's when you pull out your own money, pay that fixed price, and officially become a shareholder.
And here's the fine print, the crucial realities. Until you exercise, you don't own a thing. You're not a shareholder. You don't have any rights. And you have to come up with your own cash to make the purchase. But here's the biggest risk. If the company doesn't do well and the stock's value actually drops below your locked-in price, well, that coupon is worthless. Your options are literally worth nothing.
Okay, so that's options. Now let's talk about the other path, restricted stock. And this is a whole different ballgame. Instead of giving you the right to buy shares in the future, the company just gives you the shares on day one. It's like they're handing you a treasure chest, but it unlocks over time.
See, with restricted stock, you are a shareholder from the moment you get it. You have voting rights, you can get dividends, the whole shebang. The catch, the restriction, is that you can't just turn around and sell those shares until they vest over time, and that protects the company, right? If you decide to leave early, they have the right to buy back any shares that haven't vested yet.
Okay, everybody, lean in for this part, because this is where things get really serious. If you get restricted stock, you are immediately faced with this monumental, super time-sensitive tax decision that, frankly, most people don't even know exists. And making the wrong choice, or just making no choice at all, can be an incredibly costly mistake.
So let me ask you, you get this stock today, it's worth something, but it's restricted for a few years. When do you think the IRS comes knocking for their share? Is it when you get it? Or is it when those restrictions finally disappear and the stock fully vests? The default answer might just surprise you, and I'll tell you right now, it is not in your favor.
Let's walk through a quick story. It's super simple, but really powerful. You get a grant of 100 shares of restricted stock. On day one, the company is brand new, so the stock is worth just $1 a share. Fast forward 2 years, the company has exploded. When your shares vest, they're now worth $1,000 each. A year later, you sell them for $1,500 a pop.
So by default, here's what happens. And honestly, it's kind of brutal. The IRS ignores the grant date. They wait until your shares vest. And at that exact moment, your 100 shares are now worth $100,000. The IRS looks at that and says, aha, that's $100,000 of income for you, and they send you a tax bill, even though you haven't sold a single share or seen a dime of cash.
In our little scenario, this is just devastating. First, you'd owe ordinary income tax on that $100,000 value. That's the highest tax rate, just like your salary. Then, when you sell, you pay capital gains tax on the extra profit. The total tax hit, a whopping $50,000. Think about that. You just lost a third of your earnings.
But what if there was another way? What if you could flip the script? What if you could go to the IRS and say, hey, forget about the vesting date. I want you to tax me now on day one when my stock is only worth $100 total. Well, that's exactly what something called the 83B election lets you do. And just look at the power of that choice. By making the 83B election, your total tax bill plummets to just over $30,000. You just saved yourself nearly 20 grand. That is incredible. And it's all from filing one simple form at the right time.
So let's be crystal clear about what this is. The 83B election is basically a letter you send to the IRS. You're just telling them, tax me now while my stock's value is super low. By doing this, you ensure that all the future growth, all that appreciation, gets treated as a long-term capital gain, which is almost always taxed at a much, much lower rate than ordinary income.
Okay, I absolutely cannot stress this enough. This is not a choice you can put off. You don't have forever to think about it. You have an incredibly short, brutally strict window of time to act.
You have exactly 30 calendar days, and I mean 30 calendar days, not business days, 30 days. From the date your stock is officially granted, you have 30 days to get your 83B election filed with the IRS.
And this deadline, it is no joke. There are no extensions, no do-overs, no pretty please. If your form shows up on day 31, it's too late. You will have permanently, forever lost the chance to save what could be tens or even hundreds of thousands of dollars in taxes.
So this is your playbook. This is what you do. The very moment you receive a restricted stock grant, that 30-day clock starts ticking. Talk to your company or a lawyer immediately. Get the form, fill it out, and mail it with certified mail so you have proof it was sent on time. And a quick note, if you're not a U.S. citizen, you might have even more paperwork, so it's even more urgent to act fast.
Look, at the end of the day, this is on you. Your company provides the incredible opportunity with the equity, but figuring out the taxes, that responsibility is yours. Making an 83B election is one of the single highest leverage financial decisions you can make in your entire startup career. The choice is yours.